Hello traders, welcome to FreeFX. It's the 10th of October, Monday. So today was an interesting day, of course, start of the week. We are now in the second full week of October, and of course we've got a lot of events coming up this week, particularly Thursday CPI data. Thursday happens to be the 13th, and the last time we had a 13th of October CPI release was on Tuesday the 13th of September, and that caused quite a bit of price action on the SPX, S&P 500. Now, this is the weekly chart. It's actually absolutely strewn with arrows. That's not because it's a weird indicator, it's just really my trades, longs and shorts, and it may make it difficult to read, so I will go down to the daily and probably take these off in a minute. But what you can see from this quite clearly is that the promise of a bounce on the CCI from the minus 200, which sort of appeared around the end of September, didn't quite materialize because we've had really nothing except sort of very small candles on a sort of weekly basis. And also we've come off the Bollinger Band here, but the CCI hasn't really picked up pace. So we're still in this kind of territory where, just like back here in May, we are sort of at the bottom of this range, but we sort of come off for a short while and then continue lower. So we could call it a bottom bounce from the CCI, but it's quite difficult to get a signal like that. You really have to just follow it through and then continue if this gets to the moving average in this case, or some kind of level that indicates that we're still in a downtrend. So that level will be represented by the WMA around 3880 at the moment, and that would basically be where we need to get. Of course, this will continue declining, so by the time we got there we might end up bouncing around 380, for example. So it's hard to say how this is going at the moment. Very, very small candle, so price action has been very, very subdued, shall we say. So that's just one aspect I was going to cover. So let's go to the daily, because I think that should be the next point. So let's go to 1D. And this will get us the kind of perspective that we need. So the June low, represented by this green line here, I haven't extended it because obviously I'm sort of trying to be honest about this. But you can see that it has really created this sort of magnetism about it, as I call it. Nothing really has moved past it. We've been below it, we've been above it, we've been below, but essentially we're stuck. Plus minus, this is 3657 more or less. That's 3770. So say 100 plus points, and below it's 358. So I'm just going to round this up to 100 points above and 100 below. Now that may seem like a lot, they do sound like a lot of points, but actually in the greater scheme of things, being stuck around a 100 plus and 100 below, it's not really a great situation. So generally speaking though, looking at the daily, we've had this 2-day rise versus the 4-day rise here before the CPI day on Tuesday the 13th of September. This was another type of kind of rise, but very similar, and as I described it, you could sort of draw comparisons and kind of, so I went short based on that and then got some nice profits. So that continues just like it did before, so we could see just more continuation. Indeed, I did trade short again today after that, thinking another short trade might, but it didn't go very far. So trade wise, the candle today, the daily candle, was very small indeed, because the high was 3654 and the low 3587. So it wasn't even 100 points, it was something like 73, and that's quite small compared to what we had on the Friday of last week with the North Farm payrolls, where the low was 3649 and the high was 3759. So that was 140 points. So it basically double That's a high and a low rather than the open and the close. So that's including any wicks or shadows like candlesticks might have. Again, for the CCI, as I mentioned before, we got to the zero back here on CPI Tuesday, 13th of September. This time we haven't got to the zero, just dipped about 30 points shy of that and then started declining. So it does look like a repeat of that. Whether we can achieve full tilt down to minus 200 remains to be seen, but that could be what we're going to next. Nothing else to declare on this. I would, however, actually show you, and I think I need to really get rid of my trades, otherwise it will be completely illegible. I need to show you the VIX because I haven't covered it in my previous videos recently, so just want to kind of get the VIX back on the scene, because you'll notice, or you might say, well, I know this already, so I don't really need to be told, but the VIX is currently back in the 30s. We are at 32.45. So if I just do that, you see that we kind of dipped here. That was the middle of August, and from the middle of August we continued, had several dips, the latest of which was beginning of last week, Tuesday. And then I said back then that this formation, these two humps, were very similar to these two humps that we had before the so-called bear market rally. And I was getting worried, because we had similar ones here, which led to a decline, similar ones here, and I thought this might lead to another decline. But actually, I was proven wrong, because we've actually picked up pace and we've come back to the high of the 27th of September. And it looks set, just kind of visually, and also I think fundamentally, it looks set to continue higher. Now at this point, do we continue this dribble, or are we going to get some kind of event that causes a spark and creates a real momentum? By a spark I mean something that isn't just up to 20s or 30s, but something higher. You know, so previously I was saying that getting above 20 was where we needed to be, and we got that. Now that we're in our 30s, we need to see that rising further to a 40. So essentially the next 10. So if you think of levels of 10, multiples of 10, when we get to 40, we're starting to see something more significant in price. Some people talk about full capitulation as the sign that there's a big panic or fear or risk aversion, or like total risk aversion, like everything that is priced, you know, historically high will really rinse some value off. I mean, that's the other thing, right? Because let me just kind of go back to a slightly more extended view. This line that I created in my last video reflects the I'll take off the peaks as well. Reflects the pre-pandemic crash. So that was the high, and that was the highest high at that point. Okay. Now I measured this, and it's 5% off. It's 5% off, not the June low, but where we are today. So the low of this, basically. 5%. So we need to drop 5% to get to the same level that we were before the coronavirus causing markets to temporarily crash. Well, not crash really, but just lose a lot of value very quickly. And we have come down, so when I said, you know, market sort of value, etc., and deleveraging, on the S&P 500, we've come down already 25%, or just over 25%. So what is another 5% drop when you consider that we've already come down 25%? Not much. It's 1/5. So that could happen, and it could happen quickly. And we've heard about Credit Suisse being safe and all the rest of it. But if it's not Credit Suisse, it could be something else that's not been foreseen. You know, China, recent data about housing recently. I think it was. There was quite a drop. But there could be something. I'm never sure that the long-term capital management ghost of we are too good to fail does not come to haunt us, really, because they too in the early 90s did not foresee the Asian crisis. The Asian market crisis basically hit them hard, and it was a black swan sort of situation. They got into more and more leverage that they weren't able to cover, essentially. And if I remember right, the government, in fact the Fed, had to have a crisis meeting and intervene to save the whole system because they were quite a big fund. So if Credit Suisse were to collapse, that would be a terrible thing for the whole system, because it's a critically important bank systemically. So if it's not the Credit Suisse crisis because of China, but it has sort of echoes of the long-term capital management and the Asian crisis, and also 30 years. But I think that is something that one should keep in mind. I'm saying that because 5% isn't much off a 25% drop, but that would take us to this sort of 3391, which is below the 3500 that everybody's been talking about. Some people say, what's the level below that? Well, that's really hard to, as I said to somebody, would you expect a ball to bounce off a black hole? If you threw a ball into well, it wouldn't. It would just go down and down and down. So, and then through to the other side, so to speak. But it's not really a situation where you want to guess a level and for any trading reason sort of use it for. I think on a day-to-day basis, yes, you can buy little bounces, but I think that the trend is very much down. So just to finish, I think I need to go to the 4-hour, which is interesting because on the 4-hour we are pushing on the Bollinger Band, and we've had a modest bounce, but really a modest one. So now the question is, what happens? We've basically come all the way down to the negative 200 on the CCI, as you can see. And that was back here on the Friday of last week with the non-farm payrolls. And then we've emerged from that, and we are where we are. So the question is, what is this telling us? Well, not much really. I think we need more data and more price action. It was quite a subdued Monday, so we need to have a bit more of the week. I think maybe tomorrow might be an interesting day. So keep an eye out on tomorrow to see if anything comes up. There is the CPI on Thursday, but frankly, do we really need to wait until Thursday for price to do something? Sadly these days, I think the way this year has behaved, sometimes you literally have nothing going on except slow dribble and then a big move. So that was the move of the CPI Tuesday. Then not a lot of price action really, kind of chopping around between 3925 and 3842, talking about 80 points. And that was from the 13th of September to the 21st of September. So, that's a trading week plus minus. And then the big drop there from the Fed rate decision, which caused another sort of ripple effect. But, each of these candles is quite small, but still, that's fine. And then without any events, you have this sort of little rally. And now we've basically undone that little rally, and we're back where we were here on the 2nd of October. So we have quote unquote wasted 9 days to be back where we were here. So now we are at the at this low which is the lowest from this cycle point of view, because it's lower than the June low. We just need to see where we go from here. So without further ado, I will try to do another video on the Wednesday, because it'd be nice to have a midweek video if I can. But if not, it will be back on the Friday of this week. Take care. Bye bye.